Wrap. I'm Greg McKenna. I'm at the Mary MacKillop in Sydney again, and it's a little bit before 9 today because I have to cover the Performance of Construction Index for Business Insider and also the RBA's Statement on Monetary Policy at 9:30. It's also a bit of an exciting day for me. It's my last day writing for Go Markets because on Monday I start writing as Chief Market Analyst for AxiTrader, which is all a bit exciting. A bit of a bigger role at a bigger firm, so looking forward to getting into that. Yesterday, when I rewatched my video, I noticed that when I shared the charts, it didn't work very effectively. So I do apologise about that. So I won't go to MT4 today, but I would recommend that you have a look on my website, chart of the day for sterling or the pound, however you want to call it, GBP. The pound last night came under heavy selling pressure after the Bank of England left rates where they were. Mark Carney then tried to put a bit of two-way into the market in a Bloomberg interview, saying that people should still expect that rates will rise next year, but he's been singing from that hymn book for a while now. And last night's inflation report showed no signs of inflation. So 80 months in a row, the Bank of England has left rates where they are. No signs they're going to be hiking. Sterling crashed 152. It's leaning right on support at the moment from the low a little while back. I'd probably say 150, 170. If that gives way, then look out below. I always respect these kind of trend lines in these kind of wedge patterns unless or until they break. And with non-farms tonight, who knows? You know, we could get a shocking print. Could be a 135 instead of a 180, and it could be a 210 as well. But yeah, 150, 170 is the level for me. If it goes through there, then I think it's broken and heading back towards lows. Of course, that would probably also mean that Euro was breaking down through 108. And as I discussed yesterday, a move down through 108 on Euro would be a sign that it's on its way back to 105. But for me, the key thing I'm watching at the moment are US 2 years. And I think I can, yesterday when I shared my Reuters screen, I think that that did work. So let's just have a look at these 2 years. There we go. That's perfect. Right. So this is the 2 year rate going back 10 years. And you can see that we're pretty low. Now, if I change that to 5 years, this is really important because what we've got at the moment is we have got the US 5 year rate at the highest level it's been since 2011. Now, this morning when I wrote my morning reports, it was 0.845. Now it's sitting at 0.8295, and let me just close that. It's sitting at 0.8295, and it's waiting on the non-farm payrolls tonight. Now, from my point of view, if we go back to the 10-year view, right, you see that and you go, okay, it's up near the peak, it's probably going to hold. But if you have a look at it on the 10-year view, right, it's looking really like it could break out. My sense is that if we get it back to 1% or something like that, that's going to fundamentally change the investment outlook for stocks, for bonds, globally, for credit, those sorts of things. So that's one I think that we should all be watching very closely. Now, of course, the market's expecting, the Reuters poll is expecting 180,000 jobs to be created for October, and employment data is always volatile. That's the nature of employment, data. It's a survey that tries to estimate numbers for an entire economy that includes 300, 400 million people in the States. So there's always some slippage. But if we get 180,000, or we get some positive revisions to September or August or things like that, then you're probably going to see the expectations of a Fed rate hike locked in. One of the things I think last night, which was really important, probably the most important thing I think the Fed has said this week and last, we've had numerous people put a rate hike on the table and say December's live and that kind of stuff. But Dennis Lockhart last night from the Fed, I think he's the Atlanta Fed boss, he said that the Fed has successfully repositioned market expectations about a hike. Now, we know that back in September, there was a lot of chatter and also in the more recent meeting, there was a lot of chatter about market expectations not being anywhere. And I think Larry Summers back in September said the Fed only tightens when it's more than a 60 or 70% expectation that they're going to tighten, blah, blah, blah. So what that suggests is part of the process of tightening is not just the data, it's the movement in expectation, so it's not a shock. Now, on one hand, the fact that stocks in the US last night were only down mildly, even though non-farms is probably going to be strong, is an indication you might say that things are okay, the market can handle a Fed rate hike. That's why I'm watching US 2-year rates, because I'm not convinced that the market can handle a Fed rate hike. If they say one and done, then yeah, probably. But if the data continues to be strong and they say one and then they have their dot point and it looks like it is going to, continue to rise for the next few years, then we might get a different reaction. So watch those 2 years. In Australia today, we have the statement on monetary policy. We also have the PCI. There's some manufacturing data out in the UK tonight. And after last night's weak factory orders, there's some important data in Germany, I should say, down 1.7% as opposed to up 1. There's some important data in Germany again tonight. That was probably a bit scary coming close to the screen then. But overall, that's it from me today. Sorry I couldn't share the charts, but the wireless signal here wasn't quite strong enough. Have a great weekend, good trading, and I will see you back on Monday when I'm sure we're going to have plenty to talk about. It really does feel like a good solid print is going to potentially kick euro, kick sterling, get the Aussie moving, jam those interest rates up, and we could really have a big night tonight. Have a good one. Bye for now. Don't forget, you can always find me at Twitter, at Gregory McKenna, at Business Insider, and at my own website, gregmckenna.com.au. Have a great weekend.